Hello friends, welcome to my YouTube channel Simply Stocks, and today I'm going to talk about in detail about KPIT, in which I'll give competitor analysis and revenue breakup and everything that you need to know about KPIT. So this is a detailed video. Please like and subscribe my channel as well, so that you get such videos going ahead. Let's get started. First of all, a disclaimer that this is not a stock recommendation, and people taking any position to any share that I talk about should do that with their own due diligence and research, and I am not in favor or against any company that I talk about. Before I talk about KPIT, here's a small request. Kindly support me on Patreon. And once you do that, it will help me grow the channel, help you also ask me questions and eke out answers in greater detail. Once you get the $10 membership, you'll have access to my portfolio, my watch list, and number of podcasts I put up from time to time. And also, once you pay $100 upfront, you get 1 year access by paying for 10 months. For detailed market or company talk, you can directly email me when you want things out with a fee. And also, if you cannot pay on Patreon, you can directly email me, and you can get the WhatsApp membership as well. You get all the benefits of Patreon on WhatsApp. Now about the company. Established in 1990, KPIT provides IT infrastructure for autonomous driving, ADAS, and they are also into vehicle diagnostics and engineering. Their top 17 clients include account for 84% of the revenue. So they don't go by having 5 or 7 of the top clients in which 70% of their revenue comes from there. They are pretty diversified in client base, and which augurs well going forward on a long term basis, that even if they lose some of the clients, they'll be able to have not that effect. The effect on the revenue will not be that much. They have presence in North America, Europe, and Asia, and I'll give you the breakup of how the revenue comes from all these places. With offices in 13 countries, it is a diversified global company. The market cap of the company is around 15,000 crores at the moment, which looks extremely attractive. We'll discuss about the valuations as well in this presentation. If you look at the financials, then these are Q1 numbers, the June quarter numbers, which are pretty good. Sales went up by around 21%, and profit growth was seen year on year of around 40%, which is pretty good. Virtually zero debt company. There's low promoter but high institutional holding at around 40%, which also looks pretty robust. A return on equity of 22% is decent enough. Margins have been maintained around 19%, which was pretty surprising with the kind of difficult environment that KPIT has been working in, the geopolitical environment, and how the currency fluctuation and pressure of you can say recessionary pressures in the Americas as well as in Europe. We are seeing the kind of numbers that they have ended up producing is pretty good. So results at a glance, margins went up by 200 basis points year on year and was stable Q on Q, 18-19% margin, and the management has also said that this is probably the lowest margins that you could expect, and so it will maintain around 18-19% even if the environment becomes difficult. One of the best among peers in terms of operating profit margins. Yes, there is one company that is doing even better than that, and that's why the valuations there is much better. I'll compare KPIT with that company, that is Tata Elxsi. I'll compare that as well going forward in this presentation. But sales growth of over 20% in a very difficult business environment is commendable, and profit growth of around 40% is even more you can say special, because they have maintained their margin and eventually profitability did come in, and that is why probably the stock has maintained those levels of around 8-9 months back. So it was around 570 580 in December last year, and it's around 570 580 today. And the reason for that has been these strong numbers that the company has produced, and plus the forecast of demand being even high for EV and for autonomous driving, etc., at least in the second half of this decade. So from FY25 onwards, I see demand picking up, and the management as well as other companies in the same space globally have talked about demand picking up big time from 2025 onwards. So everybody is bracing up for that, and people are accumulating this stock. between those 520 to 580 region. In most of the geographies they have produced growth. Will give you the geographical breakup as well, and cash position has also strengthened over time. Cash on books has also increased, so a prime candidate to have more acquisitions going forward. Probably inorganic growth will also take place. So if you look at the revenues for the last 3 years, since FY19 till FY22, which is the year that has just gone by, so from around 640 crores, even after the pandemic years, they have gone up to 2,430 crores. That's a fourfold jump in sales, and that is probably the biggest reason why the stock has gone up 20-25x, although revenue has gone up 4x. But when we look at the profit picture, you'll understand as to why there was so much of euphoria buying into the stock. One more thing that need to be looked at is that in FY20 they had a revenue of 2150 crores, and FY21 it did not dip that much, even though it was one of the worst years for many of the companies, because of the global pandemic year, that it was a very difficult business environment, and even there they have produced virtually the same numbers as in a non-pandemic year, and that sets its path towards a more you can say revenue growth, and that really happened with a 20% growth in FY22. And remember that even from April 21 till March 22, there were at least 2 quarters in which India was ravaged by the pandemic, and most of the countries in Asia and parts of Europe, US were ravaged by it. So a clean year would be this FY23, that will see the numbers really crop up, which we can compare from FY19, and it looks extremely good. We are penciling in at least a 20% growth in sales over this 3 quarters as well, and so we could be looking at something like 3000 crores of sales, 2950 crores of sales. Based on that, at 15,000 crore market cap, it's trading only at 5 times earnings, which looks extremely attractive. So that's the first you can say line of call where I see that the stock is attractive compared to its peers, trading at only 5 times FY23 revenue. If you look at the profits, now this is also interesting. From 55 crores in FY19, the profits have jumped into 276 crores this time around. This is a yearly profit, and the growth has been phenomenal. 90% growth over the last year. Yes, I agree, it was a pandemic driven year, but even in FY22, at least for the first quarter and a half, things were not that great on the ground. So a strong recovery by the company for producing the third and fourth quarter numbers the way they have produced. And even if you look at FY20 and FY21 numbers, everybody thought that the numbers would dip, and most of the companies, what happened was in FY21 numbers dipped sharply across sectors. But what we have seen here with KPIT is that they have maintained their margins, and I'll give you the margin picture in a bit, but they have maintained profitability as well at the same level as in a non-pandemic FY20 year. So this all set it up for a big FY22, and that is exactly what has happened. I believe that FY23 will see a similar kind of a growth, but FY24 onwards things will look even better, and we can see bottom line really go up big time from FY24 onwards. In terms of margins, as I explained, margins were around 14% last time around, say in FY19, it has grown to 18%. And remember, as I mentioned, in FY21 also margins remained, in fact margins expanded from 13% to 15% in a difficult environment. So 200 basis point jump there in the margin in FY21, and we are looking at an even bigger jump this time around from FY21 to 22, as we see here. So as I mentioned, in terms of the margin picture, from 14% in FY19, the margin dipped in FY20, but even in a very difficult environment in 2021, the margins increased by 200 basis points, and it increased by 3% or 300 basis points by, you can say, FY to 18% in FY22. So really, I feel that things are looking up for this company in terms of margin picture, and I see when things really get going on the European and US fronts, when this recessionary pressures end by, you can say, FY24, the numbers will look even better. I think they'll come back to the margins of 20%, 21%, and with the higher sales growth, as we are seeing 20 to 25% sales growth, the numbers could be exponentially better on the bottom line than what we are seeing currently. In terms of the breakup in the sales front, geographically, we have a situation where we see that 42% of their business comes from most of their business comes from the Americas, and their next level, I mean, the business that comes from is from Europe. So the European business, as far as, so rest of the world, in this, the rest of the world business is around 30%. The European business is 28%, and sales from the Americas is around 42%. So the business that comes from Europe is around 28%. In that regard, that's why they are slightly insulated compared to other companies like Mastech, where the business is around 60% from UK or Europe. Here the business from UK or Europe is of around, you can say, 28%. So, and Asia or the rest of the Americas, or the central regions, etc., is 30%. And the US business is not, sorry, Asia and other parts or rest of the world is around 42%, whereas the Americas is around 30%. So the business from US plus the other South American region is around 30% of the total sales, and that is why they are slightly insulated, because 42% of their business comes from outside Europe or US. So here is the geographical year-on-year performance from the rest of the world. Apart from Americas or Europe, the growth was seen at around 42%. This was a very phenomenal growth in terms of, you can say, sales. Europe also saw an increase. So there was an increase of 21%. There's a 21% growth in Europe and 15% growth from Americas that came in terms of sales. Now you need to understand that most of the companies working in Europe or US in any industry are facing a lot of problems. In fact, pharmaceutical companies and many IT companies are facing a lot of currency issues and many other problems, due to which their growth has dipped or gone into negative, whereas in KPIT's terms, Europe and Americas both had an increase, or there has been a growth in terms of sales by around 21% in Europe and 15% in the Americas. In terms of profit margins, or you can say operating profit margins, in rest of the world it dipped by 200 basis point, as I said, 13% versus 15%. In Europe the increase was pretty phenomenal, 1000 basis points or 10% increase in you can say margins, which is pretty interesting considering the kind of situation Europe is in. And in Americas we had a 500 basis point dip. So in Europe, probably with other companies losing steam, KPIT is bringing in other changes of whether this is operational, you can say efficiency, etc., but there has been a 1000 basis points increase in terms of profitability or margins. Although there hasn't been greater profitability, 21% is not that great because they were doing 30-40% earlier, but the margins have expanded magnificently. So this tells you the kind of strength that KPIT has with its business and clients, and the kind of, you can say, pricing power. It is definitely a case of, you can say, transferring the price hikes to the end customers, and that has led to such a good growth in terms of European margins. If you look at the product mix of the company, then 75% of their business comes from passenger vehicles. So the passenger vehicle business is 75%. their 23% business comes from commercial vehicles and 2% are from other businesses, that is from offices or automation of robots, etc., that they bring in you can say in Southeast Asia, etc. But most of their business is passenger vehicle, cars, etc., and 23% is from commercial vehicles. And this is the revenue breakup of the verticals that they work in. So their sales, 34% of the sales comes from the ADAS domain, automated driving solutions, that they bring in. 13% is from the robotics or AI space that they provide businesses towards. 23% is from the EV side, where the EV vehicle space that they probably work on, and 30% of their business comes from their 30% of their business comes from their trains business, the automated trains that they provide, or vehicles in that space. So it is quite diversified in terms of business front as well, revenue breakup in terms of that vertical. And so eventually what happens is that there is no dependency on one particular type of vertical or business that they would be working on or they would be worried upon. It is pretty diversified, and hence it is a clear sign that revenue over a period of time will continue to be streamlined. Even if there is a dip in one of the verticals, they'll be able to make that up with a gain in. Now, if we do the peer comparison, and this is KPIT versus Tata Elxsi, and I understand that Tata Elxsi is one of the largest brand in this business, and in a completely different space with the kind of margins that they produce. But still, if we compare with the kind of business that they have, I still believe KPIT is trading at a discount. So what is happening is that the yearly sales of KPIT is around 2,450 crores, versus Tata Elxsi is nearly 2,500 crores. So the sales are nearly same, but look at the margins. So KPIT has margins of around 19% at the moment. Tata Elxsi has margins of 33%. So that is, so KPIT's margins is at least 50% lower than what Tata Elxsi is. Then if we go further, KPIT is trading at 5 times 1 year forward price to sales, not even 6 times current sales, but 5 times 1 year forward. Tata Elxsi is trading at 21 times. So there lies the difference, that okay, I understand that Tata Elxsi is one of the best of the companies and is trading at a PE of 90 because of its profit growth of around 65%. But KPIT with the profit growth of 40% is trading at only 6 times sales, whereas Tata Elxsi at 21 times sales doesn't make sense. Either Tata Elxsi is overpriced, so may come down by around 20-25%, or KPIT, if the same run rate in profit growth continues, should trade at least 11 to 12 times, which is half of what Tata Elxsi is. So there lies the point that KPIT may still double from here. I'll explain in details with numbers going forward. But the numbers here look like that in terms of price to sales, it is at a discount. Plus in price to book thing also, Tata Elxsi is something like 35 times price to book. KPIT is right now 11-12 times price to book. Again, a huge difference. I understand that there could be a 50% premium to Tata Elxsi, but not a 70 to 80% premium. So as I explained, so in terms of price to book, it should be trading at around 20 to 21 times KPIT, or Tata Elxsi should come down in terms of price to book, which I don't think will happen because of its growth. So basically what I mean to say here is that yes, I agree that Tata Elxsi is growing at a faster pace, so it is commanding that kind of valuation of a PE of 90, but KPIT producing profit growth of 40% in a very difficult time, and 50 to 60% in a very in an environment when the environment gets better, it should have a profit growth of around 50-55%. The stock should not be trading at a PE of 50, it should trade at a PE of 70 to 80. So that is my target basically on KPIT, that the PE of KPIT should expand to 70-75. And if you go back and look at its charts, probably in 2021 October or so, or even in 22 January, it was trading at around 80 times earnings. So around 75 times earnings is a possibility here with a growth of 40 to 50% if that growth continues in KPIT. So in terms of valuation, current EPS for FY22 is 10 rupees. That's what the EPS came out to be. In FY23, with the kind of growth that it is showing, the EPS should be around 13 and a half rupees. Currently, it is trading at 42 times FY23 earnings. So it's not even trading at 50 times earnings. And if we go 1 year forward, so if this is an investment from a 2 year perspective, if we go into FY24, that is 24 May, by then the results would come out. So if we can hold on to the stock from a 2 year perspective in FY24, I see more order execution leading to better profitability, and the EPS in FY24 should expand towards something like 19 rupees. Hence trading at about 29 times FY24 earnings and relatively undervalued to peers. I understand that Tata Elxsi is one of the best in the business, and that's why it's trading at such valuations, but this one can easily trade at 75-80 times based on 19 rupees earnings. This can go to 1450-1500 over a 2 year period. This can go to 1100 over a 1 year or 15 months period. That's my assessment. So I believe that Tata Elxsi is much better player in this space, but on a price to book and price to sales, as I mentioned, KPIT is trading at extreme discount. Even if we take a 50% gap between the two, that is Tata Elxsi trading at a 50% premium to KPIT. KPIT can have a price to book of 17 times, and on price to sales, KPIT may trade at 11 times. Now based on 2900 crores of sales in FY23, it can easily have a market cap closer to 30,000 33,000 crores, which currently is around 15,000 crores. So in my opinion, if the numbers continue to be this strong, KPIT can double over the next 1.5 years or so. So from a 3 year point of view, it's a buy at these levels and on any declines. A short term, there could be some margin pressure. So there could be a situation where the September numbers will not be that great. And so wait it out for the September numbers or any declines towards 520, 530 to buy into. Technically, it has consolidated for 8 months since December. As I mentioned, the stock has been trading between 570 580. So there is a chance that a breakout is possible, but wait for that breakout to buy into if you want to really buy short term from a 6 months perspective. Wait for a breakout above 600 to buy with a stop loss at 580. That would be better rather than buying at these levels, and allocate less than 10% holding, and probably invest for the long haul from a 2 to 3 year perspective. So this was my video on a detailed analysis of KPIT. Please like and subscribe my channel and hit the bell icon so you can get my videos straight away when I post it, and support me on Patreon or WhatsApp so that I can bring to you these kind of videos more. This is the first effort of mine with this sort of a video. Let me know whether you like it or not. Thank you.